Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Today's Real Estate Investor Podcast is from a town hall I recorded with Dr. Peter Linneman on February 7th, 2025. As always, Peter provided incredible insights on the economy and real estate investing in 2025, and I know you're going to get a ton of value from it. I could talk to, or rather listen to Peter for hours on end, but today's episode is just over an hour. Enjoy. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com.
Choosing the right insurance coverage for multifamily properties isn't that complicated, if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz and we'll start the conversation.
All right. Well, welcome everyone. Thanks for joining us. I'm honored to have Dr. Peter Linneman join us. This is his third time joining us. Peter is a founding principal of Linneman Associates, LLC, a leading real estate advisory firm and its affiliates. For more than 40 years, he has advised leading corporations and served on over 20 public and private boards. He has published over 100 scholarly articles, 8 editions of the acclaimed book, Real Estate Finance and Investments, Risks and Opportunities, and the widely read Linneman Letter Quarterly Report. He is also the co-creator of the popular and highly regarded Real Estate Finance and Investment Certification course, and has also co-authored the best-selling book, The Great Age Reboot, Cracking the Longevity Code for a Younger Tomorrow. Thanks for joining us, Peter.
Thank you for having me.
And guests, if you have questions, you could put them in the Q&A and we'll get to them later. Today, I wanted to talk to you about what you must know about the economy and the real estate investing in 2025. And we have about 1 hour. Certainly, it's been a wild ride the last few years, as good news is bad news and bad news is good news. But let's talk about what's going to be good and bad for the economy in the next year or so, considering the broader national and geopolitical landscape. And let's start off with economic growth.
Okay, so I think it's important to have one thing in mind, that basically 5 years ago, the United States and almost all other countries in the world shut down huge swaths of their economy for months and in some cases years on end, right? And if we would have been having this call 5 years ago and I told you that was going to happen, first of all, we would have all said, no way. And secondly, if I said, but imagine it did happen, and I gave examples like you couldn't go to sporting events, you couldn't fly to Europe, couldn't get elective surgery, et cetera, et cetera. And I said, how long do you think it'll take for the economy to normalize? I think most people would have said, I don't know, 4, 5, 6 years. Well, it turned out that kind of gut instinct is right. And that brings me to your question. We're basically 5 years on. And while not everything in the economy is normalized, we've kind of normalized. The job growth numbers are recognizable in terms of what you'd have in a normal economy. GDP growth is recognizable of what you have in a normal economy. Real GDP is still about 1% behind trend. That gap is closed considerably over the last year, which is to say 1% within measurement error. I think we're still below, but employment's still a couple of million below trend. The difference comes from productivity growth. We're below trend, more on employment than we are in real GDP, but we've got disproportionately productivity. If you say, let's look forward for the next year, let me do a real quick laundry list. I think you're going to get something in the range of 2.5 to 2.9% real GDP growth. Remember, this matters for real estate because the economy growing is what fills real estate. That's what fuels real estate demand, which is 1.5% or so of productivity growth, about 70 to 80 basis points of population growth, about 30 basis points of additional growth from us being a beneficiary of the Ukrainian-Russian war as a major oil, food, and weapons exporter, and probably net, tariffs pulling down a bit, reduced regulatory pushing the economy up a bit, and taxes staying low, and if anything, going a little lower, pushing the economy up a little bit, and you get 2.5 to 2.9. Stay tuned, right? Employment will grow something around 2.1 million jobs, roughly. It's important to know that even though the economy is much larger than it was 5 years ago, 12 states are still not back to their GDP level of 2019, adjusting for inflation. And about 15% of metropolitan areas are not back to the employment of 2019. So it's not like every place, right? It's Texas, the Carolinas, Florida, Georgia, Utah doing spectacular, but there are other places stumbling around. Recoveries tend to last 6 to 10 years. This is the fourth year of a recovery. We're not going to have a recession barring something very strange. The Fed is overly repressing the economy. Remember, I think it's still a little below trend. The high rates have no impact on healthcare, have no impact on education, have no impact on lots of things in the economy, but it does slow anybody who uses short-term floating rate money, like development, like manufacturing, which uses a lot of lines of credit, which are short-term. So 20% of the economy is needlessly being slowed by the Fed. I think they cut another 100 basis points this year. At least, I don't think they realize that, but I think they do. The inflation outlook in the last 12 months, if you take out shelter, housing, rental housing, and owner equivalent, inflation has been 1% for 80,000 items over the last year. Now, some are high. I know eggs get all the headline, but 1%. Rent, according to the CPI, is up 5% on apartments in the last year. You're in the business. Are your rents up 5% in the last year?
I wish.
Nobody. I mean, you can find a project. I have no idea why it is that. That is biasing the inflation numbers way up. The other is this concept of owner equivalent rent, which is the rent that the listeners who own pay themselves, which is a crazy concept because even if you say you're paying it, you're also receiving it, so it's a net wash. It's a nothing. No one has ever done it. And they say that's up by 5% over the last year. If you take those two items out, you've got 1% inflation, which is probably below where it'll end up, but we're down to nothing. If we've really got, let's say, 1.5% to 2% inflation, the short rate is going to come down to 75 or 100 basis points over that, which is in the high 2s and very low 3s, and the 10-year comes down to somewhere in the mid 3 range, 3.3, 3.5, 3.7. It got there 9 months ago, and then for reasons I don't understand, went away. People say the reason the long rate ran away was fear of the deficit what? These people just figured out that we have a deficit 9 months ago, or that we're going to continue to have deficits no matter who gets elected. I mean, that's crazy. They figured out what? That we have outstanding debt. They just figured that out 9 months ago. That's crazy. So the long rate, I believe, comes down. We have a lot of money on the sidelines still, as you know, both at major money centers and private equity, sovereigns, etc. It won't sit there forever. The way to think about why interest rate, the short rate, is too high is that from the time it hit 5.5%, the short rate, inflation has fallen by about 4 to 5 percentage points, and they've lowered the interest rate 1 percentage point. That says that even though they've cut interest rate, the return on short term net of inflation is actually up. And that encourages people to stay short and liquid rather than long and illiquid. And real estate, of course, is long and illiquid. I think that money starts flowing as we go through the year. It's taken longer than I thought, but that's because I thought they would have had the rate down by much more now. Inflation is absolutely under control. So I think we see a modest true inflation. It'll be overstated by this housing silliness. And I see a pretty good economy this year. It won't be the greatest ever. And it'll be a wild political ride. On the other hand, I find it quite interesting. Someone asked what I thought about Doge the other day. And I said, okay, I'm going to take any business of any size in the country. If Elon Musk or any good operator came in and examined your cost structure, do you have any doubt that they could cut 10% if they had no emotional attachment? Your company, any company of any size, no matter how well managed, because you're a little married to this employee, you're sticking with that project longer than you should, etc. If you think you could find it with any company in the country, you don't think you can find 20% sitting around the government. But you got to do it. And yes, most of the thing the government spends on is transfer payments. But what? That means we're not supposed to go after the other stuff? I mean, of course you go after the other stuff. Of course it'll be adjustments. And I'll take the one that's in the news. As you know, I have a fairly good footprint in Africa, in Kenya, with charity. So you're talking about a person who has real openness to helping developing countries. But let's talk about USAID. Am I for an organization that funds foreigners to help them and blah, blah, blah? Of course. But am I for an organization where if you cut through it all, probably a third of the money is going to consultants to do studies that really don't do anything on the ground, and probably another 10% is siphoned off through corruption in the target country, and another 10% is wasted on bureaucracy? So I'll give you one example. About 5 years ago, I believe it was USAID or some similar organization in Kenya provided a program where every school in Kenya got a computer. Well, probably a good third of the schools in Kenya don't have electricity at that point. Well, only a government would do that. And of course, the bigger the check, the more that can be siphoned off by the corruption part. I'm not saying US officials being corrupt. I'm talking about the target. And it's buying gold Rolexes for, the corrupt. So it's good that these things are being examined. Probably will lead to a little overreaction. So I feel pretty good about this year. On real estate, the last thing I'd say is the supply surge is largely over, not completely. If you go downtown Austin, downtown Nashville, there's still another 6 months. Demand is good. It's not demand that's the problem, it's supply, it's the spurt. And I think, as you know, the pipeline is emptying. And I think by late this year and certainly into next year, you're going to see strong rent recoveries.
All right, lot to uncover. Really, really great information. So let's start with the government's data that says we have 4.8% growth in rents. When does that normalize?
I don't think it does. Well, let's take it in two parts. Housing prices. Remember when they said housing prices are going to crash because interest rates went up? And I said they might go down for a month or two as people pause. This is like 2 years ago, but they're not going to go down because home prices are going up because we have a huge shortfall of single family homes, like 3.5% of the stock. And let's say 2.5 to 4.5% of the stock for something people really want. And if you have a shortage of something people really want, the price is going to go up. So home prices are going to go up for the foreseeable future with an odd blip when they don't, simply because we have a huge shortage that's not going to go away because NIMBYism makes it tough for it to go away. So the single family side, you're going to see home prices continue to be much higher than everything else as an average. If you go to apartments, I just don't know how they come up with 4.5%. All they have to do is look at the public companies, which are SEC reporting companies. They report. All they need to do is call Blackstone, Greystar, Starwood, look at CoStar data, call Cortland. If they called any of them, they would say somewhere between -2 and +2%. With a norm right around zero for the last year. I don't know how they come up with 5%. I'm not trying to suggest that somehow the data is manipulated, but it's wrong. It's just, somebody could look at me and say, you're 7 foot tall, and they could believe it, but I'm not. I'm 6'3", and you could report me as 7 foot, but I'm not. It's that simple.
You talked about population growth, and I want to get your opinion with immigration policy. And just because they say policy doesn't mean what truly happens. But like here in California, in construction, there's never enough workers here. There's never enough, and now you have people that aren't showing up because they're scared of people showing up and deporting them. Quite honestly, I've heard that from builders in this area. So how does that affect our economy? As far as you talked about, population growth and job growth, when potentially we could be losing a percentage of the workforce.
Okay, so the best kind of semi-consensus numbers I can find, and they're hard to get because by definition, they're not documented, right? But the best numbers I've been able to find suggest around 15 million people out of 335 million. About 15 million people are illegal, okay? And the best numbers would suggest that around 11 million of them work. And that's because they skew young and they skew male. So it's a much higher percentage than the population as a whole, okay? So I'm not saying those are the numbers, but let's work from that. If it's 11 million out of 164 million workers, you're talking like 7% of the workforce. Heavily in agriculture, heavily in hospitality, heavily in landscaping and domestic, heavily in construction, or at least parts of construction. Not so much in accounting, although I'm sure there are some, right? So it's a notable group. I believe what you're going to see over the next 3 months are very visible. Let me do it differently. If I told you there are 15 million illegals, do you have a hard time believing, I don't know, 5 to 10% of them are not good people? Like, really not good? By the way, 5 to 10% of the American population, do you have a hard time believing are not really good people, right? Just productive. I mean, just maybe not the biggest felon. So I imagine that you're going to see some number of that, like 5 to 10%, who are, for lack of a better phrase, pretty identifiably bad, being high profiled, sent out of the country. And they're going to shut down the border back to what it was during Bush, Obama, and Trump. And so the influx will still occur, but more normalized numbers. And so the deportations, I'm guessing, let's just use 10%, will be 1.5 million higher than normal for a year or so. That's, to get it through and then they go back to quote normal, where normal is Bush, Obama, and Trump. Okay. Now, I don't think you see much more than that. Why? Because the majority that the Republicans have in the House is pretty narrow. Narrow to the point, if there's a contentious bill and you need the Republicans to carry it, make sure nobody's out of town. I'm not joking. I mean, it's that narrow that if you just happen to bring a big bill when several of Republicans are out of town, it doesn't carry, right? What do you think happens if every construction site, every restaurant, every hotel, go right through it, sees their good people being sent away in handcuffs in droves? What's going to happen is everybody in that business is going to get on the phone to their representative, and they're going to do it fast. And the representatives are going to say, hold on, right? Hold on. And they are representatives that I'm talking about are the Republican representatives who are going to say, hold on. And he cannot lose more than about 3 or 4 of the Republicans if he wants to get anything through legislatively. And so I think you're going to get, it's the beauty of the system in a way, right? Which is you're going to get feedback that will dampen it. And what they'll then start turning their focus to is, my guess, processing rather than deporting, right? I mean, remember, some of these illegals are here, they're undocumented. They're here, but they're in limbo, being processed. So remember, that's the other thing is, if you're Elon Musk, you think you don't want to process everything faster and more efficiently. So remember, that also is one of the solutions, is process more efficiently and more rapidly so that we don't have 15 million. Imagine we could process everybody legitimate overnight. We'd go from 15 million down to about 200,000, right? That's the real goal. So at least that's how I see it playing out. Will it have some effect here and there? Yes. But I think when it calms and normalizes, most of the ones who are going to get deported are not the productive. That's not to say no one. I'm just saying most.
Yeah, that's a great way to look at it, because I know that talking to people, I know that's a huge concern. You said 100 bips cut prediction for this year, and I know all the real estate people on this call were really excited. What would be the driver of that?
No inflation. No inflation. Let me just start out. Suppose I told you inflation is going to be 1% the next year. 1.5%. Let's say 1.5%. Why would you have a 4.5% short-term rate? Short-term on overnight deposits. Why would you have 300 basis point spread? It's not for liquidity. It's not for risk. It's not for duration. And that's why I say, if you told me 75 basis points spread over, well, that gets you to 2.25. 100 basis points gets you to 2.5. And so I don't think they'll come down that far. They should. I don't think they will. But remember, the Fed's been a terrible predictor of themselves for almost all of history. And I think they're, Willie Walker has kind of famously kissed my feet, because in the middle of the last year, when everybody was saying no cuts, maybe 25, I said there'd be 3 cuts, and they cut 100 bips. All I was saying it is on the same thing. Inflation was over, and they just have to realize it.
Now, some would argue, tariffs will increase inflation, and some of it is negotiations and other things. But how do you think that will play into that?
Okay, so let's just understand tariffs. Tariffs have averaged $2 per every $100 of imported items purchased. Basically through late Bush, Obama, and the first 2 years of Trump, $2 per every 100. Under the last 2 years of Trump and all 4 years of Biden, it went to $3 per 100. Okay? Did you see runaway inflation associated with that? No. It was rounding error. Why? Because it's only about 15% of the economy getting $1 on 102. So if you had a cost increase, just think about it this way. If you had a cost increase of $1 on $102, is that going to be wildly inflationary? And you go, of course not. And especially if I told you it's only on 15% of the economy, you say, I got bigger fish to fry. Okay, so now let's say it goes to $5 on 100. That's $3. No, excuse me, that's $2 going from 103 to 105. That's $2 on 103 on 15% of the economy. It's not big enough to have a huge effect. It's just sit back and do the math. I'm not saying it's good. I'm just saying you have to be realistic about it. And then you add to it what you were saying, which is it's hard to know what will really happen, because right or wrong, he views them as a negotiating tool. So whereas historically, come on, behind closed doors, presidents have been saying to Mexico, if you don't get your drug gangs in order, we're not going to do this, or we're going to do that, right? That's been happening. You and I don't know what it is. Behind closed doors, they've been saying to Europe, if you don't spend more on military, this is what we are or aren't going to do. The difference is Trump says we're going to do tariffs. Now, he's just saying it in public rather than in private, right? Whatever the threat or carrot is. And so I don't know whether they do and how much they do and what he really does. And I'm making up what I'm about to say, but doesn't intuition tell you that we've said to Germany for many years, if you don't spend more on military, we're not going to do this. And yet we kind of continue doing this. Not totally, right? I think the same thing happens. This is just another lever in the bigger game.
Yeah, love him or hate him, politics aside, he's gonna push, the limit a little bit more than some of the other administrations.
I don't disagree with that, but there are two basic styles of negotiating. One is scream, shout, hyperbole to the max, confuse the hell out of the other side, hope they want something more than you do, and you back off, right? That's I'm not saying good or bad. That's one style. And the other style is a more educational version, which is I'm going to educate you about what I need. You're going to educate me about what you need. We're going to do it very calmly, very quietly, and we're going to figure out a way we can to make it work. Right or wrong, come on, Trump's a New York real estate guy. Is it surprising that he instinctively goes to the hyperbolic, big claims, et cetera? And you've negotiated with people like that. And yes, sometimes a deal doesn't get done that should have, but you deal with it, right? It's just a different negotiating style than the I'm going to and I'm much more the educational type. I think probably if you leave New York City, probably 80% of negotiators are more what I would call educating, and only about 20% are the hyperbolic kind of wild claims. If you go to New York, I think it's kind of the flip. And maybe not quite that extreme, but he's a New York real estate guy. Of course he does hyperbolic negotiations.
Yeah, good point. So we'll kind of move more towards real estate. Is there a particular asset class? I know, markets are different, but is there a particular asset class that you really like going forward, or an asset class that you don't really like in 2025?
So let's stay in 2025. I have a friend who uses the phrase "get rich money" versus "stay rich money." And I think everybody kind of grasps it. Stay rich is I don't want my lifestyle to go down. I'm willing to take some losses, but not a loss that makes my lifestyle change. All right, that's kind of stay rich. I want to return, but I don't want to endanger. That money should not endanger my. If you're talking about stay rich, I think it's hard to argue against apartments in general. The swings in NOI are lower than the swings in other asset categories. Freddie and Fannie provide a deep capital market in addition to banks and so forth. Pretty steady, predictable cash stream. Economy's growing. Obviously, you have to underwrite each project. So I'd say for stay rich money, I would do apartments, and I am doing apartments. And in particular, if you can find an opportunity zone deal where you can tack on some extra tax benefits in exchange for taking development risk, could be a good play. On the get rich money right now, I'd look at good office properties. However, I would do them with very low debt, and I mean very low debt, because you don't know when it comes back. You don't know to what extent it comes back, and you don't want to be right and have been squeezed out before you were right. And so 50% debt may be way too much. You may be needing to do office at 10, 20, 30% debt, maybe zero debt, so that you can cash flow a bit. You have the ability, if you lose a tenant, before you gain a tenant, you have the ability to put in good news money. But I do think we've hit bottom. Leasing is starting to pick up for better properties. It's not wonderful, but leasing has picked up. You know that. And capital is what? Almost coming, tiptoeing, looking around the corner back. A year and a half ago, the only people who would have bought an office building would have been some high wealth family in the neighborhood who was just because, right? You're seeing a little institutional interest. So there's a good chance that capital comes back faster than you thought. Leasing comes back faster than you thought. You go in with very little debt, and 2 or 3, 4 years from now, if things turn out well, you then finance, take money out, and do. So those would be my get rich, stay rich kind of views.
And I'll tell you, it's so hard to get a deal done when you have very little leverage because you have to raise a lot more money, and that's harder in this environment too. People are still very, very cautious. It's everyone wants a good deal, but when there is a good deal, they're too scared. Everyone moves in a herd. So
My friend Sam Zell, I think I told you this before. My now departed friend Sam Zell, I'm not going to try to imitate his voice, would say, everybody always told me they wish they were there with me in 1974 and 75 and 80 through 83 and 90 through 95 and right after 9/11. Said, but nobody really wanted to be there then. They all think they wanted to be there then, but they didn't really want to be there then. They were much more comfortable in 86. They were much more comfortable in 96. They were much more comfortable in 2006 or 2016. And I think it's what you're saying. We all would wouldn't you like to go out and play in an NBA game? And the answer is yes, right until you started playing. Wouldn't you like to suit up and play in the Super Bowl? Yep, right until you suited up and went out on the field and got hit. It's that kind of exercise.
Yeah, because this is such a great buying opportunity right now when cap rates are really high and inflated, and we're buying stuff well below replacement value. It's a no-brainer, yet some people are scared and they've gotten hurt because they were just throwing money at anyone in 2021 and 2022, and obviously we're burned by that.
If you've been divorced, well, how many times did Mickey Rooney marry? Like 9 times or whatever it was. Most people stop after about the third time, after the third divorce. On the other hand, there are others like Zsa Zsa Gabor who just keep doing it, right? And I suspect most people get put off by being burned, as you call it, right? And it's understandable. Nobody wants to get burned. We're a survival species, right? And our instinct is survive. And I think the biggest thing office has going against it right now is usually when office is in trouble, so are apartments, so is warehouse, so are hotels, so is retail. Good retail's not in particular trouble, and good apartments are not in particular trouble. I'm talking in rent and occupancy wise, right? And industrial, rent and occupancy, okay. And so why do I need to do office? When they were all in trouble, it had a sporting chance. But when it's the only one in trouble, now you're really kind of saying, I have to really bet against it, what everybody else is saying.
I've got one more question for you, and audience, if you have questions, put it in the Q&A. I see one question in there already, but let's if you've got questions, put them in there. So what do you think of the lending environment will be if Fannie and Freddie gets privatized? I'm not sure what your thought is on that. And then obviously with rates hopefully coming down, and regulation maybe softens, do the lenders really start lending? Because they are obviously super conservative right now. It's hard to get a loan. What are your thoughts on that?
Sooner or later, they got to put their money to work. You can only stay on the sidelines so long. And it's taken longer than I thought, but that's because, as I said, I didn't think the Fed would be this slow lowering the rate, rewarding doing nothing so handsomely. That's why I was saying the interest rates come down 100 basis points, inflation's come down 400 or 500 basis points. So it will come off the sideline. And you may remember back in, let's say 2010, money's never going to come and money's never going. And then suddenly it's 2013 and you go, oh, I'm still complaining about there being no money, but there's money. And by 2015, you were going, I have trouble sorting through all the money to decide which I should take, right? And that'll happen again. That will happen again. Money seeks a home, and we are way below normal transaction volumes. And my research shows, look, when money flows, cap rates come down. And when transaction volume picks up is when money flows. And when you're way below normal transaction volumes, which we have been now for 2 years, of course cap rates are up. And my research shows it pretty clearly. Cap rates have relatively little to do with interest rates, and they have a lot to do with money flowing or not flowing. And by the way, this time money didn't flow because of the rapid rising of interest rates, but in the mid 70s, early 70s, it was because of the oil embargo. And then it was because of a deep recession and 18%. And then it was 9/11. And then it was, so sometimes it relates to capital markets. And sometimes, it relates to other things. And when money flows, values improve. And ultimately they will. There's a lot of people sitting on a lot of money that need to find a home. I feel comfortable they will. They'll come back to the best assets in the most liquid markets first, and they'll go to the lesser markets, which can be quite good, but they'll go to lesser markets and less liquid markets last. And I feel pretty comfortable the money will come back. It's just a matter of when.
Yep.
The other way I say it is there's always been a battle between fear and greed. And greed wins about 6 out of 8. And fear wins about 2 out of 8. And we happen to be in the 2 out of 8. But by its nature, greed wins. And I don't mean greed in a bad sense. Actually, it's more optimism, pessimism than fear, greed. Which is, do I see all the impediments or do I see all the possibilities? And the pessimism undoubtedly wins. And you see your own shadow, you fall prey to your own. Just think about us as a species. You've walked home. I live in Center City, Philadelphia. I've lived in Center City, Chicago, and so forth. And it's perfectly safe. I know I'm 6'3", 6'4", or 205. I'm an animal, right? And you walk home one evening and you hear the leaves rustle behind you and you're convinced it's 9 people who are going to cut you up in small parts, and you start walking faster, and now your heart's racing and you start jogging and there's nothing there. But our survival trait kicks in, and we're in one of those moments.
Yep, absolutely. All right, we got some questions here. How do you see the LA fires affecting the Phoenix and Tucson market? Long-term inventory in LA will not be able to handle the inventory.
It's got to be good in the near term for Phoenix, probably Salt Lake City also. It's got to be good for them in the short term. It's hard for me. The only thing I've been able to, when I say I figured out, that I believe I've figured out unambiguously is a place like Malibu. I do think I know what's going to happen, which is maybe half to 2/3 of the people are not going to rebuild their home. They're going to sell. They're going to take their insurance as it is. They're not going to go through the permitting. They're not. And they're going to sell to somebody who's going to put together 3 or 4 lots and build a big, big home, because a lot of those homes in Malibu were not very big, as these things go, not very big, right? I think that's unambiguous will happen. What happens more broadly is a little harder to figure out. I think people your age, by and large, won't leave. They'll figure, because they have a business, they have roots, they have this, they have that. Their kids are in a school there, etc. I think people my age are more likely to say, yeah, I'm 74. I don't want to live in a construction zone the next 5 years. I don't want to go through permitting. I don't want to pick an art, et cetera, et cetera. And I can see them kind of saying, I'm out. And it's hard to know exactly how that plays out. It will have, I think, a big impact on the election next year, but I don't know how it will turn out. If it improves the politics, it will be a great thing. Could be a horrible, it's like the Chicago fire was horrible, but Chicago became a better place after it. The London fire was a horrible thing, but it became a better place after than it was before because a lot of the things it triggered. Tragic, but the case. But unambiguously good, cannot hurt Phoenix and as I say, probably Salt Lake City.
Yeah. Yeah. I mean, even I'm in the South Bay, so I don't know, 10 miles away, and you just see, there's a limit that, as they always do, they kill supply where demand is booming, and it throws things in a whack. But like, they're not going to wait 5 years. They're going to move down, Manhattan Beach, Orange County, Phoenix, Tucson, Salt Lake.
Yeah, I just say, but I can see people like your age. When I say all I mean by your age, prime age, right? You're in your prime work age. You're in your prime family, real meaning of a family, right? You really have kids around you. Your mom and dad are probably still alive, maybe well in the area, etc. I think that those are going to kind of take a deep breath and figure out a way to do it. It's as you get away from that prime that it's harder for me to predict. But I do think the Malibu-ish is an easy. It's a pimple on the whole problem. You just end up with many fewer homes that are much bigger, I think, there.
We have a question here asking about what your thoughts are on student housing.
It would be great if there weren't students. It's like a university is kind of a nice place if it weren't for faculty and students, right? It'd be a terrific place. No, I think student housing, obviously, if you have a great location, you have a good basis, and you're near the Columbus campus of Ohio State or the University of Georgia. I'm not trying to be University of Florida. Harvard, if you can get there, Penn, if you places where the enrollment is bulletproof and upward biased, right? Upward sloped. I think, of course, you've got the parents on the credit. It lives on two lies. And by the way, I've paid for the lie. The two lies are the girls tell their grandparents or parents they don't feel safe in the dorms, even though the dorms are perfectly safe. And then grandpa sucks it up and says, well, if my little sweetheart feels unsafe, I'm in for so much already for their tuition and so forth and so forth. What's an extra $500 a month, for 2 years? That's the one lie. And the other lie is the male telling their parents or grandparents, I don't drink because, it's not legal until you're 21. But if any of my friends got caught drinking while I was in their room, but I don't know if I mentioned it, I don't drink. But if they got caught in the dorm, we could get suspended and miss a semester and then transfer, and you have to pay another year of me making up for courses. And by the way, I don't drink. But if it did occur in an off-campus, it's a non-event, right? Unless somebody's really getting hurt, it's a non-event off-campus. And they suck it up and say, gee, it's a cheap insurance policy for 2 years versus the risk that I have to pay for an extra term. So it exists. You have to have parents and grandparents who can foot that. But there are a lot of them. And you have to have kids willing to tell the lie, and there are even more of them. And you do have to watch campuses that are possibly shrinking, because I do think it's true that more and more, we know that nationally college enrollment's down from incredible heights, but it's down. And I think more and more people are questioning the economic value of it, and probably should, right?
Yep.
If what you're going to major in is counterproductive, it's not even non-productive, it's counterproductive, what am I paying for? And I can turn my kid into an anti-Semite by just sending him to a biker's bar with $100. I don't need to send him to Harvard or Penn. And I can turn my kid into a raving Marxist a lot cheaper than 4 years tuition. Just buy him a box set of the works of the great Marxists, And so the value of it is being questioned. Probably the best positioned are the large state southern universities, because right or wrong, I think parents think it's less crazy there than it is as you go north, northeast, or west.
Yeah, I had one daughter that just graduated, another daughter that is a freshman, and yeah, the prices are insane. But you mentioned insurance, which is a great segue into our next question, which is insurance rates are killing a lot of multifamily markets, whether in a natural disaster area or not. We're in Tucson, there's no natural disasters, and our insurance rates have skyrocketed. So where do you see these high insurance rates and expenses in the future? Like, I mean, I don't see them coming down. And how do they solve this insurance problem? Because you're going to have insurance companies, more of them even wanting to leave California and whatnot. Like, what's this? What is there a solution out there?
Well, we know that the government isn't the solution, and that's what's made California, which would have been difficult to start with. But let's face it, California, you had an insurance market 30 years ago. You had fires 30 years ago. You had earthquakes 30 years ago, and you still had an insurance market. It was as the government got further involved there, it became, because you drove insurers out and you capped rates and so forth. So California, or any place that bizarrely regulates, is a problem. You then go more broadly. I was in a conversation with somebody from South Florida, and the discussion was about how their insurance cost has gone up by a lot over the last 5 to 7 years on their residents there. And I said, how much has your home gone up in value over that time? And they said, I don't know, like 3 million. And I said, and how much have you paid in additional insurance over those same years? And they said, oh, I don't know, 50,000. And I said, would you gladly pay 50,000 in insurance to get 2 million in asset gain? And the answer, of course. Of course. And one of the reasons insurance rates go up in Florida and in general is the asset's up in value. It looks like the same asset, but it's not the same asset. It's an asset that's worth 20% more, 40% more, and they're insuring the value. If you have a piece of art and you suddenly find out it's Rembrandt, the insurance rate's going to go up. But the good news is you have a Rembrandt. And so that is partly true. Now, having said that, insurance rates are always not terribly transparent. And the one we were just in a conversation about officers and directors insurance. That has nothing to do with floods. That has nothing to do with fires. That has nothing to do with earthquakes. It should have to do with what? Corporate stuff. That doesn't change much year to year. And yet, insurance rates, as you know, on D&O, they go up and down unrelated to what's happened in the corporate litigation world, right? And it's because it's almost like they decide they need more money. They up everything they can, and then competition kind of claws it back over the next couple of years. So the insurance market is not the most transparent, at least year to year. But don't forget, the asset may look the same, but it's very much different. When you had no income, your life insurance policy was a lot less than now when you've got kids and your income stream is high and you're trying to insure to send the other kid to college and it's so forth, right? And you have to remember that.
I think a lot of people would push back on the real estate side. When the property values go up, insurance goes up. People are feeling it when their values go down and the insurance rates go up.
And that's why I say it's not totally transparent.
Right.
It's not totally transparent, but you would agree that in general, property values have gone, especially on the residential side, property values have gone up. Now you can come to office and that's kind of lagging and so forth. But I think you would agree that pretty much on the single family, multifamily side, values have gone up. And guess what? The markets where it's gone up the most are the markets where home values have gone up even more so.
I've got two more questions and then we'll wrap up. What are your thoughts on build to rent assets versus, let's say, apartments or a single family?
Good market because we have a shortage of single family homes. And as a result, home prices get pushed up. As a result, it takes people longer to save to get the requisite down payment. And the down payment is what keeps people from owning, that want to own. It's not the monthly. They're going to pay a monthly somewhere. It's the down payment. If I can afford the monthly, but I don't have the down payment, I have to rent. And as the home price gets driven up faster than inflation, faster than income in some places, you just have to save a lot longer. But I went from having the demographics where an apartment works just fine to I'm now a demographic that wants a backyard, whether it's for the dog or for the children, or I want to be in a school district. When I was in the apartment, I didn't care about the school district, but when I now care. And whereas if I had the down payment, I'd buy. And so you can think about the single family rental is somebody else is fronting the down payment, but they're doing it for an equity return rather than a debt return, right? And that's the difference. So it's niche, but it's a good market with wind at its back.
Yeah. Agreed. Well, we've talked for 57 minutes and never once mentioned these two letters, AI, and we have an AI question. What are your thoughts on AI and how will it affect real estate and multifamily specifically?
So you don't ask a 73-year-old to opine on technology. Though when I was in college, I made money as a programmer, but that was like a lifetime ago. I am not skeptical about AI, but I'm old enough to have seen 4 prior times that this time it's for real. And by the way, the arguments were the same about why this time it's real. Better crunch power, we have better algorithm, blah, 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 blah. Same exact arguments. And it turned out the crunch power wasn't as much as they thought, and each time it improves. So I'm a little skeptical, makes it sound like I don't believe it's real. Of course it's real. Of course it's going to have uses. I'll give you an example, though, that underscores the limitations of AI where we're at. You can take we could go to any high school in America, take a kid who's half asleep in class half the time and smoked weed before they went to class in the morning. We could take that kid, give him 15 hours of classroom instruction on driving a car and 20 hours of road training with a car and turn them loose and they could drive across town. Maybe not as well as you, but they could drive across town almost anywhere. You would agree?
Yep.
We have fed tens of millions of hours of driving into the computer systems for self-driving cars, and they cannot generally make it cross town almost anywhere. And I don't say that to undermine what has been achieved, but to point out it's got a long way to go. Got a long way to go if a reasonably dull 16-year-old is better. Now you say, okay, but they win all the chess games. Life's not a chess game, right? Some problems are, but life's not a chess game. I think that in the near, will it have a big impact on real estate in the next 4 or 5 years? Not a lot. I think a lot of the impact over the next couple of years will be negative, and it's going to be because people are going to trust it. And they're going to say, write a report or write a memo, and it's going to write it. And I've done, I don't know if you've done, I've done it, and I've had them write a PhD level bio on me, and it has me born in New York. It has me born in Philadelphia. It has me going to a university I didn't go to, has the wrong age. It mischaracterizes completely some things I've said because it hallucinates, which is a nice way of saying it lies when it doesn't know what to say. If you know, you can correct those. The problem is, if you saw that I was born in 1946 in New York City, and I went to the University of Pennsylvania's business school as a student, would you ever think to check that? It kind of sounds good. It sounds, but it's wrong. But it's truly wrong. And therefore, I think in an odd way, it's going to maybe induce more mistakes in the next couple of years for normal people like us. Because you're still going to have to read it. It's like the driverless cars. You still have to be behind the wheel and pay attention, being ready to override it at any time. So I think in the near term, not a lot of impact. I do think the GP1 drugs over the next 5 years are going to have a much bigger impact. And that's because you mentioned the great age reboot. We did not know that those drugs were going to do it. We were focused more on genetic kind of breakthroughs, which will still come. We spend an extraordinary sum on, let's just call it obesity, overweight, and all of its complications. And just ask your doctor, next time you're at your doctor, ask them, does the 80-20 rule apply? That is, 80% of their time and energy is put in on 20% of the patients? The answer is yes. And what you'll find is the 80 tend to be people dealing with the impacts of excess weight in one way or another. Well, if these drugs reduce that as a problem, it could free up staggering amounts of money, and it could do it quickly. And you say, well, how does that manifest? Lower costs for Medicare, lower costs for Medicaid, lower costs for your private insurance. Will it show up in a year? No, but it could show up very easily over 5 years. And that would free up a lot of dollars for other things. How much? We spend 18% of GDP on medical, loosely healthcare, and easily probably 10 to 12% of GDP spent on overweight related problems. If we only cut that by a third, that's 4% of GDP. I mean, that's a lot of money suddenly freed up, and not just freed up for 1 year, every year freed up. And you say, okay, we spend 2%, so we only end up with a net gain of 2% of GDP. That's $500 billion a year, year after year, and that could be here in the near term. And then people say, yeah, but you got to stay on it if you go on it. You're a pretty fit guy. One of the things you tell people is if you want to stay in shape through diet and exercise, that's a lifetime commitment too, right? So maintaining one way or the other is going to be a lifetime exercise. And so I think that has better potential in the near term than AI, which is not to say AI couldn't have an impact.
Well, health opens up a whole nother discussion another time, but yes, that's something I'm very passionate about. But Peter, thank you so much for your time and sharing your wisdom. Greatly appreciated. Where can people learn more about the Linneman letter and other things that you put out there?
So go to Linneman Associates, Linneman, Linneman Associates. You'll see various programs like this we've done. You'll see connections on the Linneman letter, the certification program, our books. You'll see a description of our charity, which is Save a Mind, Elimu, and focused in Kenya. Yeah, you can get all our stuff at Linneman Associates. And I know everybody watching this live knows we're like 50 hours from kickoff for the Super Bowl. So go Birds.
Absolutely. Thank you so much. I hope to see you again next year, and hopefully the Eagles bring it home this weekend.
Thank you.
All right. Take care, everyone. Have a great weekend.